Good morning, everyone. Thanks to everyone for taking the time to join us this morning. So this is our half-yearly update from Centaur, and we're going to be discussing the funds. I think there's a few kind of key messages that we want you to take away from today's presentation. I think the first point is across all three of Centaur's funds, the relative performance have really picked up year to date, especially over the past few months. We'll touch on a couple of reasons for that. In terms of the local market, we've had the Iran conflict, which has we think delayed SA Inc. returns. That's now subsequently looks like that's fizzled out. And I'll touch on the drivers that we see going forward there. And then I've got Liang Walker joining the call this morning from the UK. He's our offshore analyst there. He'll be taking us through the mega theme that is AI, and then more specifically talking about the mechanics that we see operating in the market at the moment. So just a quick overview of what's happened in the market. So we've had that massive run in precious metals, during 2025. This year's been, basically completely different. First 3 months of the year, they did well, but if you look at from peak to kind of where we are now, gold's down about 25%, platinum's down 40%, and silver's essentially half from the highs. In terms of the oil price shock, that was driven by the conflict in Iran. I see this morning the US is bombing Iran again, but the market's not really reacting much to that. I think oil's up about 2.5%. Rand's pretty firm. SA bonds are pretty firm. But we'll just show you how energy prices and fertilizer prices have moved year to date. Then we'll touch on the AI theme. Chip stocks have really been in focus. These are seen as the picks and shovels of this AI theme that we're seeing. We've also seen a massive build out in data center capacity, or a lot of capacity that's still going to come to market. That's driving a couple of themes, specifically in the energy space, and copper. So just an update on the team. So, if you've been following Centaur for a number of years, this is the biggest that the team has been. And the team's growing along with the business. We've got one new hire since our last update, all the way bottom right-hand corner there, Ryan Manley. So he's might look familiar to a few of you on the call, especially if you're a financial advisor. So he's joining us from Allen Gray, where he spent 18 years of his career. And for a large part of that, he was in a distribution role serving the IFA market. And that's what he's going to be doing over here at Centaur. So we're very happy to have him on board. Just to touch a bit on the performance. So this is the long-term track record of the Centaur Flexible Fund. There's a couple points I want to make here. So firstly, the fund is over 20 years old now, has a 20-year track record. Centaur as a business, we are 26 years old this year, so been around for a very long period of time, over various market cycles. The fund's won a number of awards over the past couple of years. Over a 10-year period, it's the number one fund in its category. I'll also just point out, 2025 was a tough relative performance year across all the funds. We had basically no gold exposure, but year to date, it's been a completely different story with having no gold and a couple of big offshore winners. The year to date performance has turned materially. The flexible fund, as an example, year to date, 4% ahead of its benchmark. I just also want to point out, if you look at the three different lines, that when we refer to the benchmark, that's benchmarks we create. That's not the average fund in the category. That light brown line all the way at the bottom, that's the average fund in the category, which our benchmark has beaten. It's the same story for the Centaur Balance Fund. Over a 10-year period, it's the number four fund in its category. It now also, well, it has a more than a 10-year track record, so been around for quite some time. And here, probably also just point out the fact that if you look at the dark gray line, which is the fund's benchmark, which is relatively close to the fund, that is not the average fund in the category. That is the benchmark that we create. That light brown line towards the bottom is the average fund in the balanced funds category. So, the benchmark's been designed in a way that if we beat it, then we should be close to the top of the list, which has been the case over a 10-year period. Year to date, this fund's also 5% ahead of the benchmark. Then the SA Equity Fund, which is the youngest of the three funds that we have. So we launched that towards the end of 2023. So it doesn't have as long of a track record as the Flex or the Balance Fund, but really that's, SA Equity is where a lot of the alpha has been generated. If you look at that flexible funds, long-term track record. 2025 was a tough year. Fund had no gold. Just having no gold exposure was a 17% relative drag for the fund. But despite that, since inception, keeping up with the market and delivering almost a 20% compound return. When we launched the fund, the initial investors, we told them, we were positive on SA Inc. We thought the market could do 15% per annum returns, talking SA Inc. So if you exclude, resources and, the rand hedges on the market, and, the fund has delivered that. So just a bit on what's driving the market, year to date over this period. So if you look at the copper line, that's really the precious metal index on the JSE. So first few months, very strong returns from that, and subsequent to the onset of the war in Iran, precious metals have materially pulled back. And then the black line there, you can just see what the JSE all share returns have been, relative to what the precious metals have been doing. So year to date, the all share is down, but holding up, a lot better than what the precious metals index is doing. Just an overall kind of a view on the SA macro landscape. So there's a couple of positive factors, and I'll touch on all of these in a little bit more detail. We've got a strong fiscal position. We've got rate cuts that we think should resume from here on outwards. There's potentially one more rate hike from the SAR, but we think over the next year, the trajectory for rates is down. We still think valuations within the SA Inc. part of the market are still very attractive. And then we've got oil, fertilizer prices rolling over. The bear case, I think we're all very familiar with. The big one is political succession, at the ANC, who replaces Cyril. There are positives and kind of negative outcomes there potentially. We've got low consumer and investor confidence in the country. Municipalities I don't need to tell you about. We've got, besides, Cape Town, we've got dysfunctional municipalities across the country. And then SA is not immune to global factors, particularly being a resource kind of rich country. Resource prices do influence the local market. I think what has been interesting, and we're seeing it again this morning, if you think back to the Russia-Ukraine war, SA government bonds kind of blew out on the onset of that, went up to 12%. But this current conflict, even given that it's been a big energy shock, SA has been trading very resilient, and that's quite a good indicator that there's demand or appetite for SA assets. If you just look at how the currency's been trading, how well our SA government bonds have been trading, and all that, within the context of precious metals also rolling over, things have actually held up pretty well. Then just to illustrate the cash or the tax receipts from the SA government, from the mining sector in South Africa. So I've highlighted two periods there, so 2025, 2026. So this is essentially last year, 40 billion rand of taxes and royalties from the mining sector that the government will get. And then at spot, even with commodity prices that have come off a bit, there's still a tailwind of 33 billion rand in additional taxes, that the government will collect, and that's more than offset the temporary fuel relief that was passed on to consumers of 17 billion rand, and this all still supports the trade balance and the currency. But despite this, and commodity prices coming off, the currency's been holding up relatively well. In terms of energy prices, we basically back to pre-war levels. So in the December period, oil was all the way down to $60 a barrel. Started trading up at the start of the year, I think in a bit of anticipation that a war would break out. But we basically back to where we were, pre-war levels. The one thing that this picture isn't showing is that, and this is often, comments that you see in the media, is that, oil prices are down, the rand is stronger, why are the fuel prices, the pump not back to where they were? And that's because we've got still elevated refining margins globally, which gets passed into, the price of fuel, but the trajectory of that is also lower. Then what we're also illustrating here is the urea price. So that's a proxy for fertilizer prices globally. This is the Middle East variant. And why that's important is because fertilizer prices are a big input cost for farmers, and that gets transferred through into food inflation. So a lower price on fertilizer should lead to lower fuel prices, lower food prices, being good for the consumer. Just in terms of long-term inflation expectations, so what you'll see here, it's the 5-year inflation expectations in South Africa. Around 2022, that peaked. That was around the Russia invasion of Ukraine, and since then, it's essentially been trending down. So there is partially some base effects in that number from 2022. But what's also been happening is that our Reserve Bank have held very high real rates with their new ambition of getting inflation to the 3% target. So I've just illustrated there. They talk about getting inflation to between 2 and 4%, but it's a 3% target. And it does look like the inflation trajectory is in that direction. So what this means for the interest rate outlook in South Africa. So if you recall, the repo rate peaked at 8.25%. So we've had a number of rate cuts since then, sitting at 7% at the moment. What this chart is illustrating is kind of Bloomberg consensus in the gray line, and the black line is the Reserve Bank's own expectations of where interest rates should go from the May meeting. But what we think will probably happen is there is potentially one more rate hike at the next meeting. We'll see what the news of this morning of the US bombing Iran, how that influences that. But the trajectory is down. By the end of next year, we should see a net 75 basis points of interest rate cuts. That's positive for the consumer. That's money in the consumer's pocket. It should lead to greater discretionary money to be spent. This also leads to lower discount rates. That leads into valuations for businesses on the JSE. The government can also then raise money or fund debt at lower rates. And corporates, if they are heavily indebted or have some level of debt on their balance sheets, that also supports their earnings because they've got lower funding costs. Just in terms of our bond market, so we've seen a big re-rating in SA government debt versus US government debt. So that's illustrated here by the line trending downwards. So this is just the spread or the difference between the SA 10-year bond and the US 10-year bond. What it's telling us is that for fiscal consolidation in South Africa is happening. Things are stabilizing. The debt trajectory looks more positive. We've got ratings agencies coming out and upgrading our sovereign debt. The market's also saying that the Reserve Bank's 3% inflation target is credible, and they're being rewarded for that. And then on the opposite end of this, you've got a large US fiscal deficit which is probably impacting the US 10-year government bond yields. But our corner of the market is looking relatively, or the market is saying is looking relatively attractive. Just in terms of SA, GDP growth, that's been very sluggish, for basically a decade. So what we're looking at here is corporate loan growth that's growing in the teens. This is usually a leading indicator of where SA GDP growth is going. So this is nominal GDP. That's the light gray line there. So we would expect GDP growth to pick up from here. Probably, 1.5%, 2% kind of a range. What's not illustrated here is, retail credit extension, that's running at 3%, 4%. We would also expect that to start picking up towards the end of the year. And part of the reason for that is that, SA banks are sitting with significant excess capital. I think it's around 500 billion that they have available to deploy. And what the banks used to do is they used to park excess capital into government bonds. If you're getting 12%, it's great, but at the moment, getting 8.5%, it's not that much of a free lunch like it used to be. So they're coming out to the market and extending credit. Retail credit extension maybe picks up towards 7, 8% towards the end of the year is the number that's floating around, and that's positive for the consumer. Credit is one of the things that kind of lubricates the economy and gets it growing. Transnet, that's the big one of the big structural changes that's busy taking place. So if you look at 2020, Transnet was transporting 213 million tons of freight per annum. That decayed then all the way down to 148 million tons in 2023. And then since then, we've been on an improving trajectory. It's too slow, but things are improving. The private sector is getting involved, private locomotives, operating on, Transnet's network, and then private-public partnerships, very public ones at the Durban port. The ultimate capacity of Transnet sits at 250 million tons. So that just gives you an indication that there's significant bottlenecks within the system and still a long way to go for this to improve. We think it will take some time, but these improvements could see SA GDP's growth moving from like a 1.5%, 2% kind of level to north of a 2% GDP growth rate. Then just in terms of valuations, so I know guys usually like to show you what the PE of the market is, but what this is an indicator that we've created ourselves. So this is SA Inc. businesses. So it strips out all the rand hedges, strips out all the miners because they can distort valuations. And what this is you take the SA 10-year bond less our SA Inc. basket earnings yield, and when this line is towards the bottom end, that tells you that SA Inc. is cheap. And what this is saying is that SA Inc. is cheaper, relative to our cost of capital than what it was prior to the formation of the Government of National Unity. Then just in terms of the currency, this is a bit of a complicated graph, but basically what we're saying is, this is purchasing power parity. The fair level of the rand versus the US dollar is around 1660. So we're at 1630 at the moment. So the rand's probably fair, maybe a little bit on the expensive side. But this doesn't mean that the rand can't overextend, onto the positive side. If we continue getting, ratings agencies upgrading our, sovereign debt, then we could move more towards, if you see the 1385 is indicated there, that's if we apply no discount to what the currency should be. So when we downgrade it to a sub-investment grade, we've applied a 20% discount to the currency as a, more of a fair value. But this is just saying if things really do improve, you could get to like a 14 kind of level on the currency. Then just a theme I want to highlight. This is something quite topical happening in the market at the moment, with the xenophobia that's going on in the country. You've got a lot of SA corporates operating across Africa. There's quite a lot of negative sentiment from other African countries towards South Africa, particularly their politicians. You have a recent announcement from Ghana, which is talking about not extending Goldfields, license in that country. There's a number of SA gold miners that have exposure to Ghana, so it's a risk. Nigeria, you've got politicians going on social media, talking about going after SA corporates. You've got MTN operating there. So this is just highlighting to you, which of our corporates have exposure to African countries. Uh, at Centaur, we've got little to no exposure to the big ones here. We do have exposure, but we're comfortable with it, given the regions they operate in. We've got APSA on this list. We've got Pepcorn, the S Equity Fund. We've got First Rand. So no, kind of like material exposure to this theme. Then just in terms of market outlook in SA, the fog is lifting. Supply side inflation look like it's mostly peaked, so we should start getting low interest rates. There is underlying demand for SA assets. You can see that in the price action and how our government bonds have re-rated. And then structural for reform is continuing, although at a very slow pace. So we continue to be overweight SA Inc. names relative to the rand hedges and resources across the funds. We're sticking to our knitting, dynamic value creation framework. In SA, we favor self-help stories. So absent any, meaningful economic growth, we still think that self-help businesses can provide attractive returns. Companies doing buybacks, dividends, all translate into attractive return profiles. Then just how we, exposed to, in the flexible funds specifically, to various sectors. So financial services, we overweight. There's some of the names that we own. The self-help stories, PPC, Aspen, Remgro, we overweight there. Resources, we've got exposure to African Rainbow Minerals, Valterra, but we underweight resources. We've on the rand hedge side, we've been buying Prosus, Tencent, Bidcorp, Richemont we own. But overall, we are underweight, on the rand hedge side as well. So I'm going to be handing over to Liang, and then he's going to be taking you through the next part of the presentation. Liang?
Yeah, great. Thanks, Nick. Morning, everybody. Right, so I'm going to be taking you through the offshore part as usual. I think that, in hindsight, one of the biggest events this year has been Claude releasing quite a transformative wave of new tools. And this really caused demand for AI tools to rocket. And it caused this rush to build out the AI infrastructure to support this. And this AI infrastructure trade has trumped all other risks. It allowed investors to look through the Iran war and the oil shock and maybe higher inflation as a corollary. And this has really driven, US returns. The S&P is up 10% year to date, but really it's driven by a small basket of these infrastructure stocks that's up over 40%. The average US stock is really kind of middling along, only up around 5, and actually underperforming other indices. Now, this will ebb and flow, but we still think this AI theme is, the next mega trend, and it will broaden out substantially over time. It won't just be localized to these infrastructure providers. So, on the next slide, I'm going to take you through our kind of key AI holdings offshore. So we distill it into two camps. We look at the enablers and we look at the adopters. So in the enabler section, you're looking at the hardware and infrastructure side of AI. Everything kind of, going into the data center. So you look at Dell. Dell provides the service for these data centers. Cattle powers the data centers. Microsoft provides access to the data center. And we think that AI is very compute intensive and it will continue to be so, particularly as you move from, training these models to inference and allowing agents to do more work and that usage goes up. And, we're really scratching the surface with the use of these agents and this inferencing trend. So we think that there is still a long demand runway for compute. Obviously, near term, there's been risk surfacing, appears to be risk surfacing around a glut. You have anecdotal evidence kind of looking at potential overcapacity given Meta wants to rent excess compute and xAI wants to rent excess compute. And OpenAI's kind of monetization ramp has kind of slowed, particularly versus their kind of mounting commitments. But then, taking the opposite side of this, you also have demand exploding. Token demand is growing over, 1,000% year on year, and by most indications, and supply is still very tight. You look at something like TSMC, they should be growing capacity north of 100%. They're expanding capacity 5%. And so demand still looks likely to outstrip supply. But as we said, there are risks. There could be a near-term glut. There usually is an overbuild at some points, particularly with such a front-loaded investment cycle. So we've pared back our positions after a strong run, but still optimistic over the long term. I think what's interesting is this infrastructure trade has been so strong, it's sucked a lot of capital from the AI adopter bucket, causing, marked underperformance in these names. And, the funny thing is historically in these technological revolutions, it's the end user, the coalface, that lands up benefiting probably the most from the new technological tools. So when you look at Nu, they're using AI to really evolve their credit underwriting models. Uber, Tencent, and Trip are all platform businesses. They could dramatically improve their network efficiency. They could dramatically optimize costs further. So we think that over time, a lot more value will accrue to this application layer, to the adoption side of AI. And for now, it's difficult to say how this will, uh, like how this will proceed. So we've taken a very barbelled, balanced approach. We're kind of, half and half, and we think that that positions us well for, no matter how this AI cycle plays out. The next slide is probably what, we find even more interesting. AI it's been massive and it's this mega trend, but it is still just the match. And we think the fuel is the kind of evolving market mechanics under the hood. And really this has been driven by passive. So, you go back 30 years ago, passive was about 5% of US equity fund assets. Now it's gone up to, estimates are indicating around 60%. And this has given way to a change in how markets behave. Markets used to behave like clocks, very mechanical. News and fundamentals will drive the price towards fair value. There wasn't that much extremity on average. And now markets seem to be behaving more like a flock of starlings. If you picture starlings, you have, these massive kind of movements in the sky, but it's very disorderly. You've got one bird following the next bird. They're all just kind of following each other. And it's quite, it looks quite beautiful, but it's manic. And in the markets context, this has created a very momentum-driven and price-insensitive market. So these next few slides, I'm going to show you kind of the key drivers that feed into this. So the first one, well, actually, let me first explain the cycle. So this creates a very reflexive cycle. So to kind of break it down in steps, how this might play out, you have this trigger event, right? So say it's news. Company ABC releases results, earnings beats by 5%, and the stock rises commensurately 5%. But then what happens is, retail investors pile in, momentum follows, the index weights go up, so passive funds have to buy. All this kind of FOMO and price appreciation makes analysts think they're missing something, so they revise their estimates higher and their price targets higher. That, of course, hits the news, prices go up again, and the whole cycle feeds in itself. And you get this very strong multiplier effect. A stock that should have been up 5% ends up moving 20, 30%. And so the magnitude of these moves becomes disconnected from the fundamentals. And it's led to this reality where most of the trading now is being done by funds that buy when prices rise and they sell when prices fall. And so now getting to the next slide, which is, these factors that like kind of feed this. Biggest one is the index effect, right? Investors understand that passive moves markets. So Tesla's a great example. I want to show that this has been happening over time. So go back to 2020, it's the COVID boom, things are booming. But rumors start, speculating that Tesla's going to go into the S&P. And, this is in early November, kind of late November, it is formally announced. And over this time, over about, a 2-month period, Tesla stock goes up over 100%. There's been no change in business fundamentals. It's simply the market anticipating very strong index flows and a big index rebalance. Now, this goes into the next example, which is a retail investor effect. I'm just using Wendy's as the most recent example, very recently. Wendy's is an embattled US fast food company, and there was news that came out about a CFO change. And this Wall Street Bets post comes out that says, we've got to save Wendy's. And retail investor buying, spikes, and the stock pops 25%. And I'm not, cherry picking here because obviously it happens, with the smaller stocks and more liquid like Wendy's, like GameStop. But even if you look at news flow, OpenAI has been speculating, what's been speculating that they might pull their IPO because of a lack of perceived retail investor interest. So these investors, these retail investors, they aren't, as financially educated. They don't have enough experience with market cycles, and they are, typically more irrational. And what we need to understand as investors is that they have become a very big demand driver of shares. They're a very big buyer of shares, and they can move markets quite heavily, not just small names, but big names too. And then this leads to this next example, which is the leverage effect. Semis has been a massive trade this year, as we all know. Retail investors have particularly been piling into this. And there's a lot of leverage products out there, particularly ETFs. And JP Morgan did a study recently that showed that, leverage ETFs in the semiconductor space are kind of taking $1 of capital, turning it into five. So the share price increases by $5 instead of one. And this is multiplier of five times. And this isn't, a sort of new developments. If you look at what Fundsmith actually highlighted a while back, they highlighted an NBER study that was showing that, these researchers have been looking at these market mechanics and they're seeing a multiplier of 4 to 5 times. So just very exaggerated moves. And this next example shows that, it doesn't always have to even have a trigger. There's this flow of capital effect, and that's been exaggerated greatly over time. So, you look at the Hang Seng Tech Index. It peaked last year, September, October. No one could tell you why. There was no news flow around it. But if you zoom out, the cycle was actually in motion, this reflexive cycle we're talking about. China Tech had simply started funding Asian semis. You can see how the two have moved inversely. And what kind of happened is as this continued, index weights kept changing for China, so there was more passive selling. Retail investors climbed in, they were selling. It became a great short play, for the momentum funds, and the whole thing fed on itself. Likewise, same thing fed the Kospi's rise. And then lastly, there's this narrative effect. And, there's this old adage, don't fight the Fed. But I think what's become increasingly apparent is that, don't fight narratives. A great example again is Tesla. They went from being a car company to a tech company, and the stock has just kept rising. Yet Tesla's long-term earnings expectations have actually been downgraded 70%. And so these narratives can trump fundamentals in a market like this for a long time. And the narrative is riding on these underlying market mechanics. So if you put this all together, you have to make the game work for you. And if you just go to the next slide, um, this is going to look like a smear campaign against Elon Musk at this point, but really he's very smart. He's figured the game out. Look at the SpaceX IPO. He just created the perfect conditions for it to thrive. He allowed what 3 times the retail investor participation. He relaxed the index rules. He got the rules relaxed. Passive funds could buy, in record time. He limited the IPO shares available, and very small floats, low liquidity, and SpaceX popped 50% in first kind of trading week, 5 days. And so what I'm really getting at here is that as investors, you have to really heed the fundamentals. Fundamentals always drive shares, but you have to be cognizant of these underlying market mechanics because things are overshooting on the up, they're overshooting on the down because of these mechanics that are changing. Okay, next slide. What are the implications of all of this? So as I just said, fundamentals still really matter, more so. Stocks follow EPS over time. They always have, most likely they always will. But in the interim, we're trying to impress investors that you have to expect wilder price swings. Things are overshooting up, overshooting down. And, you as an investor, you have to stage your entry better. There's been certain shares we've liked. There's a particular share we wanted to buy it at $60. We landed up only buying at 38. We exercised that extra caution and patience because we understand how the market is behaving at the moment. Even though we believe the fundamentals are unchanged, intrinsic value is unchanged, we had to kind of stalk our prey. We've also been letting winners ride longer. If you look at Dell, started the year kind of 120, it moved up to 200. Numerous sell side reports saying it's full, it's frothy. We stepped back, we saw the big picture, the fundamentals were good, the market mechanics moving up were good. The share landed up going from 200 to 470. And then, likewise with cutting your losers, we actually bought Adobe for a very short stint. After the share had fallen 50% and the value, looked incredible because the fundamentals were still very much intact. And, we landed up exiting, only after about a 2-3% move down. But what had happened was we kind of, put the pieces together and saw that the fundamentals were great, but the retail investors absolutely hated it. They were talking about, shorting it. They were getting into these leverage positions, lots of derivative work at bay. And, we got out and despite the fundamentals and the share landed up still falling another 30-40%. So you have to combine these fundamentals with some sort of, mechanical, technical overlay, just an understanding. We're not technical analysts. We never will be, but you have to understand what's going on. And, lastly, most important thing, time is your edge for a long-term investor. Patience really is rewarded if you can sit on those good fundamentals and those good compounders. And this, brings us to this slide. All this volatility is creating incredible risk reward opportunities. There's many fast growing, high quality businesses that are trading at a discount to the markets, to their historic multiples, to peers. And so, we understand that these shares will overshoot on the down. A lot of them already have, but the risk reward is just getting so extreme. You've got Microsoft used to be a 36 times earnings company trading at 19 times. Uber was, 40, 50p stock. It's not 20 times. Tencent was 20, 21. It's not 12. And there's no shortage of earnings growth here. These companies are growing earnings at, plus 20%, at great returns on equity, flush cash on the balance sheet, great capital returns. It's highly likely these shares will re-rate over time. You just have to give it that patience. And so this kind of brings us to Nick, the next slide, please. Just, the outlook in general, recap what we've been saying. This market has been driven by a few AI beneficiaries. There are near-term uncertainties around the potential excess compute I mentioned, but, we remain optimistic about AI long term. We've taken that barbell approach. We think we're well positioned no matter how the cycle plays out. And then to really highlight that these share price moves are really being exaggerated by these evolving mechanical, technical factors. And you have to incorporate that into your approach, even if it's just being cognizant of these factors. And, as always, we're using this rising volatility to our advantage. We've been topping up shares at, incredible risk rewards, the kind of ratios we haven't seen in many years, and very positive on our long-term positioning and our holdings. Thanks, Nick.
Okay, thanks, Liang. So just to conclude, we think SA Inc. businesses, so there's still a, kind of a valuation, underpinned to them. A lot of businesses are doing self-help, either cutting costs, investing in some cases where they need to, returning, capital to shareholders via buybacks, dividends. Offshore is very stock specific, even though we do back themes. And then if you overlay all of this with, I guess, Centaur's edge, it's been a repeatable process over a number of years. That should translate to a positive long-term outcome, for clients and the funds. So that wraps it up. We're going to move over to Q&A. And Ryan, I think Ryan's on the call.
Yeah.
Maybe you
Yeah.
can, I don't know if you want to maybe also just like introduce yourself. I did give a brief intro, but and then we can go through some questions.
So thanks, Nick and Lane. Some very good, interesting points there. We do have a few questions that came through on the Q&A, and we also got some questions that came through previously on email. Lane, I'll maybe start with you since you've just finished. And there seems to be this differing AI strategies between the US and Chinese companies. So maybe you could give us your view on this and who you think will be the winner.
Okay, thanks, Ryan. Quite complex. I think the main difference is really the US is going for, it's all about the frontier. It's all about having the flashiest, most advanced models. And China is taking its usual kind of approach where it's more of a fast follower and it's more about cost efficiency. And so, even starting this year, you saw about maybe 6 to 9 month lead between what a US large language model can do and what a Chinese model could do in a short space of time. And notwithstanding, a chip shortage, the flow of chips to China is restricted. Chinese models have been able to get to about 80–90% of what a US model can do. And they're doing it at, about 50–60% lower cost. The prices are actually about 1/10 to a 1/100th of the price less, but you have to use a lot more tokens. So net, you're saving about 50–60%, but you're getting a model that can do 80–90% of what the US model can do. And I think, we think this is very interesting because at the enterprise level, that's probably the option, that you might go for. You're also seeing this move towards open source and open weights. And I think that, the kind of writing is on the wall to some extent that, enterprises in the West and the East are kind of saying, the preferred approach is a good enough model, and particularly at lower pricing. Who benefits from this? There's always going to be enterprises that will flock towards the US models. There's going to be enterprises that will flock towards the lower cost Chinese. I think what's very interesting is, Microsoft, one of the holdings in the funds, suddenly Satya Nadella, the CEO, who we regard highly, he's pivoted towards saying, we're going to be kind of more model agnostic. These models might be commoditizing, and they might be able to give you access to Chinese models like DeepSeek. They overlay, Microsoft's strong governance and security, and you might actually have access to that. So we think that there's going to be particular winners in the US. We might be one of them. In China, obviously these model providers, like Zippu and Minimax, doing very well, but we think probably one of the biggest winners is going to be Tencent. And the reason is cloud and the hyperscaler approach, by Alibaba and Baidu gets a lot of buzz in China, but it's not their core business. And those cloud businesses they run are, deeply in the red on a free cash flow basis. And the core business is really e-commerce for Baba, and it's, advertising for Baidu. Now, Tencent has a particularly good opportunity to monetize it because it's kind of taken a meta approach to some extent, but Tencent is going to monetize it indirectly. And we know that in China, there's less propensity to pay for technology. So they're going to monetize it indirectly. They're going to bulk up their advertising models. They're going to improve their gaming production. It can help in the fintech business. They're going to increase the agentic capabilities of the whole WeChat network and monetize that indirectly. And we think that the inferencing costs will be lower for them. Their new head of AI is, very well revered, and he's taken this low cost efficiency approach. He's saying the network's got to work for the enterprise, not just being flashy on the frontier. It's got to work for the enterprise. It's got to give them good value and good ROI. And so we think that, Tencent's very well positioned in China. And yeah, as I say, there will always be people that will opt for the frontier. There will always be people that will opt for the cheaper, good enough version. How this plays out, we don't know, but we do think it makes more sense over time that the more kind of open source, lower cost efficiency kind of model, might win out for now.
Okay, thanks, Len. And then Nick, you mentioned about rate cuts in South Africa. So now the question is, do these influence your investing decision on asset allocation and the stocks that we pick?
To some extent it does, but not like the stock specific will, always take preference. So, I mean, where it does directly influence, we're taking a view on, what kind of like a growth rate a business's, earnings can grow at. If you've got a highly indebted business, and a lower interest rate, that's going to almost like supercharge their earnings growth to an extent. So, that might influence, having bigger position in a business like that if we're confident about it. But it's really, business specific. We do like have a model where we track, how asset equity has performed relative to interest rates historically. So, and if you back test it, it is supportive. So that also does influence, maybe going a bit overweight, versus our benchmark. So if you look at the flexible fund and the balanced funds benchmarks, those are the strategic asset allocations of those two funds. So yeah, it could influence going a bit more like overweight.
Okay, perfect. Thanks. And you mentioned about our holdings there. We have a couple of questions around Aspen. So maybe you could
Yeah.
just give us our view on Aspen and what our current holding positions are.
So Aspen we've held for a number of years. Basically since COVID. So we've traded it kind of at lower levels, sold it at higher levels, but it's been in the funds for quite some time. Overall, Aspen has been disappointing. There's a couple of things that, didn't come through. There's a bit of, bad luck. They lost a very big or contract with, I guess it's public now, Moderna in the US. Which really set back the earnings or the manufacturing business's earnings. More recently during the Iran, kind of conflict, while it was ongoing, we did pare back Aspen. We still have it as a position across all the funds, but we did sell some at, kind of higher levels. And reasoning for that is, if the recent transaction that they did, so they sold their Australian business, which has basically de-geared their balance sheet. So they're probably maybe in slight net cash position at the moment. If the buyer, which was a private equity party, used the Iran war as a reason not to go ahead with the acquisition, that would have been materially negative, for the share price. We did pare back a bit, but we still hold it. I think here, there's a couple of levers of optionality. So they've got their GLP-1s or the weight loss drugs that, you would have heard about. They've got a lot of manufacturing capacity to produce that for themselves, but we view that more as kind of optionality on the upside, if they deliver on it or not. But yeah, it is still holding across all the funds, just smaller than what it was probably a month or two ago.
Perfect. Thanks. And Lang, back to you. You're probably better positioned than us sitting in an emerging market here in South Africa. But maybe you can give us our views on emerging markets and then maybe even compare them to developed markets and the opportunities that we might be seeing.
Again, there's kind of this old adage that with the West, you really need to be focused on what's happening at the company level, and with emerging markets, you need to be quite focused at the macro level. And I think with emerging markets, there's potential for this dollar weakness to kind of catalyze a bit of a rotation. We were very overweight on US equities for a number of years, and I think that it is overdue. There are a lot of exceptional businesses in emerging markets, and one of the ones we're invested in is Nubank. And you've got this business that is growing its earnings at 40% a year, and it's got this exceptional, highly efficient digital banking model that they're rolling out globally. And so what starts off as a local Brazilian story lands up becoming a wider LATAM penetration story, and now they're moving into the US as well. And I think that Nubank is very symbolic of a lot of the emerging market opportunities we're seeing out there. Again, I know the question is more at a macro level, but I think that us, we're typically stock pickers offshore. We're finding exceptional value. If you look at China as well, and you look at something like cattle, cattle's at the forefront of battery technology and the breakthroughs they've made in sodium ion and, partial solid state. It's going to solve, battery problems and energy pain points we've had in the Northern Hemisphere. It's going to dramatically expand the TAM, and that's a business that could be growing double digits for the next, 20 years. And, when we bought it, it was only on, a sub 20 multiple and growing that quickly. And so we have been, I'd say, and Nick can corroborate this, but we have been increasing our kind of offshore emerging market exposure. Obviously, we're predominantly South Africans, so we already have a massive emerging market tilt, but we have been increasing our exposure there. China's always been, a kind of favorite for us. You have to understand the boom bust cycle of China because it really is. Bobby Axelrod said it's like a pig on drugs. You never know which way it's going to go. Actually, quite true, but. There we've been increasing exposure to Trip.com, which has this, again, it looks like this, emerging market kind of Chinese business solely, but already over 40% of the business is now international. And the market it's expanding into is basically twice the size of China. And they're in this, two-leg race with Booking.com. They have these cultural advantages that should, allow them to win. And there's a growth runway here that could be, 10, 20 years long. The Chinese travel volumes increased, over 10 times over the past decade, and this market is bigger. And so you've got this, this company that's trading like an emerging market stock, but it really is worth, a Western premium. So, putting this all together, we think there's really great risk reward if you go out and you do the work in emerging markets. Because obviously a lot of these returns have been concentrated in, the theme of the day, typically in the US. And even with, semis, you're starting to see those emerging markets get that favor, in terms of Korea and, um, how the semiconductor trade is evolving. That's increasingly emerging markets localized. So, we are positive, we are seeing more value there. And I think over time we are, evolving our positioning to be more, kind of offshore emerging markets focused. Nick, do you want to add anything what you're seeing?
Yeah, just I think it's always be careful when you like comparing EM and DM. So look at, if you look at EM in this season, why they've been performing, it's because of, the whole semiconductor memory stocks that are absolutely pumping and dragging up those indices, completely. So it tends to be very different to, I guess, like prevailing narratives that you might find out on EM. And then that's to the point, that's Liang saying. So we're not taking like broad brushes and going, we must be in EM or we must be in developed markets, or it's very country specific and it's more theme. Oh, sorry, it's not very country specific. It's very stock specific or business specific. And it's more, whether that's backed by, a big theme or not, um, versus investing based on geography.
I think just one last thing that I would add is that it does help if you have, a kind of rotation into these emerging market stocks because you can have a very good company and it's kind of a diamond in the rough and it gets overshadowed by what's happening at the general country level. And so it does help if there's, a flurry of capital going into emerging markets, then, that's kind of time to size up in these positions and that's when they can really, run.
Thank- Thanks, guys. Sorry, I'm just cognizant of time, so we've got 5 minutes, just over 5 minutes left. But Nick, I do want to ask you this question before the last question that I do have. Is this comes from the audience? Did fuel prices have a bigger impact on food inflation compared to a muted or maybe delayed effect from fertilizer prices due to our planting season? And then, do you anticipate further increases, or will it remain at current prices?
So we're not economists. We're not, going and predicting, exactly what food, prices are going to do. But it's more the comment on food inflation is more the trajectory and looking at, kind of like the main inputs to it. Maybe the one risk to mention on food inflation is, everyone's predicting that El Nino will happen. It seems like it's quite certain by December, but it's probably more important, what it does next year. And there's virtually no kind of like predictability yet. It's too far out. And then also the maize harvest in South Africa this year, from my understanding, is we're going to be sitting on kind of like excess inventory, so that should shelter us a bit. If we do go into more of a El Nino or drought kind of conditions.
Perfect. Thanks. And then just my last question, that just to wrap up the Q&A section, is 2025, where the relative performance struggled a little bit, but it's turned for 2026. And I think the question then is, what have we done differently to get this different performance, and how will that change going forward as well?
I think I mean, we put a line into a presentation every now and then. We say, stick to playing your own game. So that's basically what we've done. We haven't changed anything, materially. We've just kept on doing what we do. We've had, a big winner in Dell Offshore, like Liang mentioned. We've got Delivery Hero Offshore that's also performed very well year to date. Then some of the local names that we hold, have been performing while you've got precious metals that have come off materially. So that's supported, relative performance. Now there was a time in 2025, and you could see this like on a daily basis. Precious metals would go up, and then the rest of the market would kind of like fade or go down. All they were sucking up basically all the capital in the market. If you think of it, if you're running like an SA equity fund and you target 100% equity content, if you're chasing momentum, you're going to have to sell something to chase it. So, that kind of whole story feels like it's reversed. And that's working in our favor. And it's not by us, doing anything differently there. It's just sticking to our knitting and buying businesses that we think can, compound over time. If you go look at that, the one slide, so the SA equity fund's performance, you'll see that performance is also with a lot less volatility than what the index has been. So you almost have like the SA equity fund kind of trending up while you've got these big swings in the index, which is resource heavy.
Perfect. That's it from questions. So
Okay, great. Yeah, so I think that covers everything. Thanks so much for joining us. And we'll see you guys at the next update. So we do these presentations, twice a year. If there are any, financial advisors on the call, if you haven't made contact with us yet, Ryan's your guy. You can find our contact details on the website. Feel free to reach out if you want any more information. And I guess that goes to everyone on the call. Feel free to reach out to the contact details, and any questions we haven't answered that have come through. We'll send you guys emails with more comprehensive answers. Okay, thanks so much.
Yeah, thank you.
Thanks, Lane.
Thanks, Nick.
Cheers.